Matt, can you lend me a couple of euros for coffee?
Let me have a look in my wallet. Here's €5 for you.
No, thanks. I'll give it back to you later.
Wait a minute. You're just going to give me back €5? Don't you remember the episode of our podcast on interest rates?
I do. That was a very good one. Okay. You want me to return the €5 plus interest? Is that what you tell me?
Well, sure, but I'm not only talking about interest. There are a lot of other factors at play here in me lending this money to you. I mean, €5 could be worth a lot more by the end of the day. Currency values go up.
They also go down, Matt. Maybe I should be giving you back less than €5.
Hang on. I don't want to get less than the money that I gave you back. I want to be sure of getting at least my €5 back.
But I don't want to promise to give you more than €5 when it's possible the euro could go down.
Well, we don't argue about this. It looks like we need to figure something out that makes us both feel that we aren't taking too much risk.
How do we do that?
I've got it. Financial engineering.
What's a financial engineer?
Well, I happen to have a very good one sitting right here. Thomas Ribarits is head of the European Investment Bank's Financial Engineering Division. Thomas, let me bring you in on this. I assume you'll back me up here. What should we do to make sure Allar and I can go ahead with our €5 investment?
It's not an investment. It's a loan for a coffee.
Money is money, Allar. Thomas, what should we do?
Well, let's take it step by step. Well, first of all, I think you're both based in Luxembourg, so your home currency is the euro. I would say, looking at both of your faces, I would consider you to be pretty reliable people. Given the time span between, let's say, the investment to buy the coffee and the promised repayment is very, very short, I would tend to say that credit risk is very low, i.e. negligible. Now, it's true that short-term investments currently in euro, if we think about overnight investments, indeed are happening at negative interest rates. But, we're speaking here not about two institutions dealing with each other and putting a lot of cash over the counter. I'd say let's have common sense prevailing. And let's just settle on a €5 loan, which by the end of the day should redeem at €5. Can we agree on that?
Yeah. That's all sorted out. Allar, you can go and get your coffee now.
No, I'm not thirsty anymore. Let's just do the podcast. So this is a dictionary of finance. This episode is about financial engineering.
Our financial engineering expert, as I said, is Thomas Ribarits. He has a PhD in system theory and time series analysis. Don't we all, of course. He worked in risk management at the European Investment Bank before moving over to the bank's treasury.
He has also performed tandem parachute jumps. Tandem jumping is a way of mitigating risks, Thomas. It's less risky than jumping on your own. That sounds like the essence of financial engineering, am I right?
But to a certain extent, indeed, financial engineering, or more broadly speaking, risk management, is about diversifying risks, yes. So it's better to rely upon two persons than just to rely on a single one, indeed.
Which persons are we talking about when we're talking about financial engineering? Who's on one side, who's on the other usually? Is it my mum and Allar's mum, or is it banks? Who's in this market?
Well, in principle, I would say, financial engineering is just about applying math to finance problems. And finance problems, that is, problems of investing money, affect us all in the end, right? I mean, it could be your mortgage loan, it could be you buying a car, it could be an investment bank in the city of London trying to figure out some fancy instrument. More generally speaking, as I said, it's not only about options. The history of financial engineering dates back further to that if indeed you follow my definition, which is just basically applying math to financial problems, right? It's also interesting that financial engineering as such is not a discipline on its own. It's not like electrical engineering or mechanical engineering, which you can study at universities. It's really a multidiscipline thing. It's just sometimes drawing upon techniques in math, in statistics, in econometrics. Nowadays, a lot of computer sciences, probability theory, and applying them to problems of, in the end, investment of money.
That's been one of the criticisms of financial engineering, is that instead of using a lot of complicated financial models and algorithms, investors should be using more common sense. And I think that kind of criticism became very prominent after the last financial crisis, which was largely blamed on, people engineering very complicated financial products. Is that what caused it? Is it financial engineers' fault?
Okay, you had a lot of headlines at that specific time when we're speaking about the financial crisis, in particular the U.S. subprime market issues that we now all very well aware of. There were indeed headlines that it's the fault of the crazy quants and the mathematicians and their strange formulas, in particular this formula which was set up by Lee, Gaussian copula, for modeling joint default, joint loss distributions. Financial engineers have always been aware of, let's say, the shortcomings of their models. Even Lee himself knew very, very well that the model that was used to value these, let's say, complex structures, we can talk about them in a second, because in the end they're not so complex to explain, that this model had its shortcomings very, very clearly. Interestingly, at that time, the market participants were happily using that formula to value their securities, despite the fact that, mathematically speaking, this particular formula is extremely far from being anything like a consistent model, as opposed to other formulas, like Black-Scholes formula, for instance, which has a very good sound theoretical foundation. So this formula has never been consistent, has never been satisfactory to any, let's say, half-serious mathematician. Still, it was used by the market because it translated prices into something which people could live with for other reasons, or traders could well understand. The formula was wrong, evidently. Everybody used it, and then including rating agencies, by the way, used it for rating, i.e. for assessing the credit risk of these strange structures. But so I would say no. It's really, in the end, it's always I would say the greed of people which cause crises, and not the usage of specific.
Right. So we shouldn't blame financial engineers for what traders do with their work any more than we should blame, let's say, automobile engineers for people who drive too fast.
Let's put it that way. I mean, I don't want to put away blame from quant desk at investment banks, who have always been very imaginative in trying to actually set up ever more complex structures and valuing them with ever more complex models, which were not necessarily, let's say, founded in reality. But in the end, yes, I mean, it's about profit. And
But what are these things? I think that's one of the things that people who are listening now will be thinking, okay, so it's a model. So there's a computer and I put something into it. But what is it? You've brought some books today, more books than usually people bring to the podcast. They look extremely complicated. In fact, when Allar opened one of them up, he said, "Oh my." because there are lots of formula in there that go on for a long time. They look very, very complicated. Is that where it starts? You write some kind of mathematical formula, and then you figure out how to put that into the computer so that the computer's computational power can run this constantly. Is that how you start a model?
In principle, yes. So it's not about computers. The computers are a tool which sometimes help to obtain solutions to mathematical problems, but they do not replace, let's say, the creative act of putting on paper some formulas. Yeah, that's.
But the basic idea is to try to give a price to something over time.
Yes, maybe it's the easiest way really to illustrate it is by using the Black-Scholes example. The way also I do it with, or I did it with students, and I still do today, is very simple. There is a very, very strong idea of pricing options, which is the so-called replication idea. And the replication idea is very simple to grasp. If you can replicate the cash flow that an option will give you by combining other assets in your universe in a clever manner. So if you can actually find a strategy to put together two assets such that at the end, at the expiry of the option, these two assets have exactly the same cash payment than the option itself, then by logical deduction, I would say, the price of this option must be exactly equal to the price of buying these two assets today, because they will give you precisely the same cash outflow tomorrow. And that idea is really the idea of Black-Scholes. So that's where it all started. So basically, you start off with a very simple universe of assets. So imagine you have your €5 today, and I give you now two possible investments. One is called bond. Okay, so you invest €1 in the bond, and tomorrow you get back, let's say, €1. We even take the zero interest rate example that we started off with. So it's a very simple investment. Yeah. So you, Matt, you give to Allar €1 and he gives tomorrow back €1. That's very clear. Yeah. Everything's deterministic, right? There is no uncertainty. And then, Matt, I propose you another asset, and this asset is called stock or equity. So also you put in €1 today. And let's assume if the world is bright and the sky is blue tomorrow, you will get €2. All right. If, however, there is a thunderstorm and things don't go well, you will get 1 cent. So basically nothing tomorrow. Okay. So you now have the choice. Yeah, you either put the €1 on the bond, you get back €1, or you take a little bit of risk, and you get either €2 or 1 cent tomorrow. That's all you have. And now I invent another product. And this other product is called option. You know, if tomorrow the stock is at €2, I will pay you the €1 difference. Okay, so if the stock goes up, you will earn €1. If, however, the stock goes down and is worth only 1 cent, you get nothing. Now, the famous idea of how to price this option is actually is very simple. I can figure out how to combine the bond and the stock in such a manner that the payoff tomorrow of this option, i.e. €1 if the stock goes up, nothing if the stock goes down, is exactly replicated. Exactly replicated. And hence the options price must be exactly the price of this combination of bond and stock. I think that's the groundbreaking idea. People sometimes get very much confused because what I add is the following now. Matt, let's assume that you know with 99.99% probability the stock will be €2 tomorrow.
Mm-hmm.
Okay? So you're almost sure that if you invest your euro in the stock, it will be 2 euros tomorrow. Conversely, the probability that the stock will be 1 cent only tomorrow is only 0.01%. So basically, it doesn't happen. Does that mean anything for the price of this option? And the fascinating thing about option pricing is that despite the fact that you know that the stock will go to 2, if you do this replication story, you will see that the option price is not linked to the fact that you almost surely get 1 euro tomorrow. Because one would say, okay, if the stock goes to 2 euros, I'm sure that the stock goes to 2 euros, the option must be priced at 1, right? Mm-hmm. Because it will be exactly my payoff tomorrow. Mm-hmm. But it's not the case. It's not the case. I leave you with this, but that's...
Wow. So in this case... But the option actually reduces my risk. So the option should be priced higher.
The option is nothing else than a combination of other assets in your universe. It's nothing that...
But you're selling the option to me. So what you're doing to provide that option is you're actually investing in that one stock and in that one bond combined, right?
Exactly.
And you're able to sell me that option and to... because you're providing me with a more of a guarantee than I would just get on a market with the stock, pure stock. Mm-hmm. You could charge me slightly more on the option, right?
Well, the idea or the beauty of the model in a way is if you neglect transaction costs and you neglect that somebody wants. If we are friends,
just between us,
indeed, then you could do the job yourself.
Aha.
You could do, and that's what people call replication, or other people call hedging. Mm-hmm. You could just combine the bond and the stock in such a manner that you yourself achieve this option cash flow tomorrow. Mm-hmm. So now I can say, okay, I'm an investment bank. Maybe I'm better equipped, and maybe yes, I will take some margin. Let's put it that way. But within the model itself, it's basically very clean. Everybody could do this sort of replication to find out to replicate the price of and the cash flows of the option.
They could, although in financial markets and in financial firms, the people who do this are, as you mentioned, quants, so quantitative analysis. Mm-hmm. They're also called rocket scientists sometimes, aren't they? So this is very complicated stuff. In other words, if some of our listeners are, let's say, 16 years old and studying maths at school, would they be able to understand this kind of math, do you think? How advanced is the math that's involved?
I would say that that depends. The basic principles are not so complicated. I mean, I think the example with the bond and the stock, we could even discuss this in high school. When it comes to, let's say, continuous time models and so on, then okay, integration is involved, and you hear terms like Brownian motion and stochastic integrals and stochastic differential equations and stuff like that. But and that requires obviously some university training. But again, it should be more about common sense in the end, because all these models with their nice formulas, most of them, by the way, not being solvable by means of writing down a formula, but you need a computer in order to simulate, in order to get the solutions, should definitely be cross-checked against common sense. And I think it's more interesting to really look at the basic ideas behind these models than to look at the equations, because people tend to get lost in equations.
I'm happy not to look at the equations. That's fine with me. I wanted to, because we're nearly out of time, I just wanted to ask a couple of other things that when I was reading about this came up. One is volatility. Mm-hmm. One of the inputs that's very important for, I guess, most of these models seems to be volatility. What is volatility?
It's the fact that a certain variable may take on values out of a range. If the range is relatively wide, we tend to call the volatility high. And if the range is relatively narrow, then we say this variable has a relatively low volatility.
But the ranges you include in your formulas, these are based on historical performance. Is that right? I mean, you basically you take what's happened to a certain kind of a financial product in the past, and you assume that in the future it should not go beyond that range.
That is true as far as, let's say, risk management applications are concerned. Indeed, that certain financial variables and their historical volatilities are indeed important in order to get at least an idea about where they could go in the future. By the way, one reason why financial engineering, or in particular option pricing, took off relatively late, i.e. 70s, is the fact that many assets at that point in time still were regulated. Or said differently, they had a zero volatility. If you're living in a world where basically the central bank tells you that the interest rate is 5%, full stop, you don't need to think about, fancy volatility because it doesn't exist. But as soon as you basically say you open things to markets, you deregulate. That was actually the big issue in the 70s. Yeah. Interest rates start to be fluctuating and start to exhibit volatility. Same, by the way, for foreign exchange rates. So also this asset class was regulated. There was Bretton Woods, etc., where FX rates were frozen. So you don't need math, right? I mean, it's zero volatility. And then again, the floating regime was introduced.
Well, that's fantastic. I really understood some of that. That was about as much as I could expect. Thomas, thanks very much. Now, Allar is going to buy you a coffee now.
Thank you very much.
Thank you, Thomas.
Wow, Allar, it's financial engineering, not other types of engineering, but I still feel like I'm wearing a hard hat. I must have been thinking very hard.
I'm sweating, and I'm now that Thomas has left the room, I have to say I was pretty overwhelmed.
Yeah, it's very complicated stuff. Very complicated stuff. Well, I hope it was a little bit clearer than it was earlier on. I think Thomas did a very good job of explaining it. But if you have other questions which you would like to pose to us, and which we could then go back and talk again with Thomas on a subsequent podcast, then you can get in touch with us on Twitter. I am at EIBMatt, M-A-T-T.
And I'm at Allar Tankler, ALLARTANKLER.